If you take 40% of the money supply, and that's how much gold you need by value, and we know the weight, divide one by the other, and you come out to $15,000 an ounce. So the reason I'm explaining that, Robert, is I want to be clear that there's not a central bank in the world who wants a gold standard. They're not going to go to it voluntarily.
Correct.
But if they have to, because of collapsing confidence in the dollar, then it follows that you have to go to $15,000 an ounce, because any lower valuation is deflationary, and that's the last thing you want.
Global monetary systems are rapidly approaching a massive confidence crisis as fiat currencies lose their purchasing power. Investors searching for ultimate wealth preservation must look closely at the underlying mechanics of central bank reserves. Jim Rickards, a leading economist and financial author, warns that a severe collapse in US dollar confidence will inevitably force a return to a gold standard. He predicts this systemic reset will mathematically drive gold to a staggering $15,000 an ounce, as any lower valuation would trigger a devastating global deflationary spiral. Because central banks cannot voluntarily slash the money supply without crushing commerce, repricing gold is the only logical mathematical escape route from a total currency collapse. Protecting your purchasing power with hard assets is no longer optional, it is a necessity for financial survival. Now, we present the clips from his interview. Before we continue to discuss this, please hit the like button, subscribe to the channel, and ring the bell icon. Thank you, and enjoy the video.
First of all, it has to do with the definition of a depression, and most people don't have a good definition of depression, and economists don't even use what I call the D word. They don't like it because let's compare it to recession, the R word, okay? So recession is well defined. It's two or more, or at least two consecutive quarters of declining GDP. There are a couple other bells and whistles about employment, and there's a referee, the National Bureau of Economic Research, a private, econ think tank in Cambridge, Massachusetts. They call the balls and strikes. They tell you when a recession begins and when it ends, when the expansion ends, et cetera. So, but two or more consecutive quarters of declining GDP, that's the classic definition of a recession. So people go, depression sounds worse than recession. And if recession is 2 quarters of declining GDP, a depression must be 10 quarters of declining GDP. It must be way worse. And that's not the definition of a depression. First of all, 10 quarters of declining GDP has never happened. If it did, we'd all be in trouble. But maybe during the Great Depression to some extent, but not otherwise. But that's not the definition of a depression. Depression means depressed growth, meaning you can have growth in a depression, but the growth is depressed relative to trend, relative to potential. So in other words, if your economy, if the long-term trend of recovery growth in a recovery is 3.5%, which it is, and you're growing at 2%, which we were for 10 years, that's depressed growth. You're creating a wedge. So here's the 3% trend line, and here's the 2% actual growth. Well, in between those two lines, that's depressed growth. That's lost output. You could have been here, but you're actually here. And because it's a wedge, guess what? Over time, it gets bigger. I would say we've been in a depression since 2007, that the entire so-called recovery from 2009 to 2019, that was a 10-year recovery, the longest recovery in U.S. history, but it was also the weakest recovery in 10-year history. The average annual growth for that 10-year period was 2.2%. But for all post-1980 recoveries, average growth was 3.2%. And if you go back to post-World War II recoveries, it's closer to 4%. So if you have an economy that can grow 3-4% and you're growing at about 2%, that 1%, 1%, what's the big deal? Sorry, 1% of 20 trillion compounded for 10 years is a big number. You're talking about trillions of dollars of lost wealth, lost output, and from the government's perspective, lost taxes. So that is the definition of a depression. John Maynard Keynes defined it that way. It was good enough for Keynes, it's good enough for me. If I want a gold standard, I can't peg it at 1,800 because I'd have to cut the money supply by 3/4 or more. So what's the alternative? Raise the price of gold. So notice the same amount of gold can support any amount of commerce at a higher price. So then the question is just an 8th grade math problem. It's like, okay, well, what would the price have to be to match the money supply? And use M1 as an example. And I assume 40% gold backing. The Austrians and the monetarists, they bang the table. No, it has to be 100% or you're levered. Okay, that's a debate for another day. So I'll be conservative and say 40%. So if you take 40% of the money supply And that's how much gold you need by value. And we know the weight, divide one by the other, and you come out to $15,000 an ounce. So the reason I'm explaining that, Robert, is I want to be clear that there's not a central bank in the world who wants a gold standard. They're not going to go to it voluntarily.
Correct.
But if they have to, because of collapsing confidence in the dollar, then it follows that you have to go to $15,000 an ounce, because any lower valuation is deflationary. And that's the last thing you want.
While the mainstream media obsesses over near-term inflation, a brutal deflationary cycle is silently building right beneath the surface. True economic depressions are characterized by prolonged periods of depressed growth relative to historical trends, slowly eroding generational wealth. Preparing for this impending market crash requires an aggressive, non-traditional asset allocation strategy. Holding up to a 30% cash reserve is highly recommended because cash dramatically gains purchasing power during deflationary collapses, offering unparalleled liquidity to purchase distressed, income-producing assets at deep discounts. Real diversification means moving entirely out of correlated equities and establishing defensive positions in short-term treasury notes, agricultural real estate, and physical silver. Position yourself ahead of the curve before these system-wide vulnerabilities trigger a chaotic unwinding of global debt markets and catch ordinary investors completely unprepared. Now, let's get back to the interview.
I know everyone's talking about inflation. That's fine, but deflation is right around the corner and no one's looking for it. Interest rates come down a lot. That means there could be huge capital gains on those notes. And of course, they're very high quality from a credit perspective. So, 10, 5 or 2 year notes, treasury notes, not junk bonds, the treasury notes in your portfolio. I have a big slice of cash, maybe as much as 30%. People say, I hate cash because it has no yield. Well, first of all, if we have deflation, cash could be your best performing asset because the real value of money goes up, not down. It goes down in inflation, but it goes up in deflation. But cash also has embedded optionality, meaning if things are crashing and burning all around you, the person with cash who's not stuck in the wrong asset class can go shopping. You can pick up the bargains. And by the way, the biggest cash hoard in the world right now is probably Warren Buffett at Berkshire Hathaway. He has $130 billion in cash. Why? Because he sees what I see. He sees what we're talking about. The wreck is coming. And again, you get to go shopping. I like real estate, not so much commercial real estate. I think it's early, but residential real estate, multifamily housing, farm, other kinds of income producing real estate. That's a winner. I like gold, but 10%. People say, yeah, Jim Rickards says sell everything, buy gold. I've never said that. I don't think it's a good idea. But 10% slice gold and silver. By the way, silver will, in a real severe crisis or social disorder, a monster box, which is 501 ounce American silver eagles, costs maybe $15,000 or so at the market. That's like to me, it's like having batteries and flashlight and water and plywood in a hurricane. You want a monster box around. And that's, by the way, that's real diversification. I run into people, they've got 50 stocks and they say, I'm highly diversified. I've got 50 stocks in 10 sectors, semiconductors, minerals and mining, consumer non-durables. I go, you're not diversified. You may have 50 stocks, but you're in one asset class, stocks. They're all going to go down together or they're all going to go up together. But when you have a slice of stocks, gold, silver, real estate, cash, treasury notes, and maybe some private equity, et cetera, that's real diversification. And that portfolio will get you through the storm. The global money supply is about, I'm using M1 and the major economies, which is about 80% of the global GDP, is about 33 trillion. And there happen to be about 34,000 tons of official gold. That's not all the gold in the world. That's the official gold held by central banks and so forth. Well, you just do the division. Okay, divide the 33. Take the 33 trillion and just say you need 40% backing. Some people would say 100%, but historically 40% has worked pretty well. So you need about 12 or 13 trillion dollars worth of gold to back up that money. Well, if you have 34,000 tons and you need about 13 trillion dollars of gold to back up the money supply, what does that come to? We'll just divide by one by the other, and again, you get a number close to $14,000 an ounce. So there are two completely independent methods. One is the technical historical look. The other one is a monetary look based on money supply. But interestingly, they come out in the same place. And then there are other ways of getting to the same answer. So that's I feel very strong. I feel it's a very solid kind of analysis to get to that number. But the other part of your question, Robert, is okay. What does it mean? Isn't this great? Well, gold's going up. I'm making a lot of money. Well, maybe you are, and other people are who have gold, and I certainly recommend it. But to me, the price of gold never changes. I think of gold by weight. You have an ounce, you have a kilo, you have a ton, you have a 400-ounce bar, whatever you may have. If the dollar price of gold is going up, what's really happening is that the value of the dollar is going down, because gold is a constant store of value. So if all of a sudden, if $2,000 gets me an ounce, but we get to a world where it takes $5,000 to get me an ounce, what happened? The value of the dollar went down. I need 2.5 times more dollars to get the same ounce. So a high dollar price of gold is again, good for gold holders, but not close for celebration, because it means the complete and utter collapse of the US dollar. That's what happened in the 70s, and that's what's happening now. The reason for dumping the banking shares is, I was the counsel at Citibank for 10 years, so I know a little bit about the banking business. The way you make money is you borrow short, lend long. You borrow at a low rate and lend at a higher rate, and you keep the difference. You got fees and credit losses and lots of complications, but that's pretty much what the banking business has always been. Well, if interest rates are zero all across the yield curve, in other words, if you're borrowing close to zero, maybe 25 basis points, and you're lending close to zero, maybe 1% or less, how do you make money? The answer is you can't. You can make a little bit of money, you can leverage it a little bit, but you don't make enough money to cover your credit losses and your expenses and your overhead and fees and a lot of other costs associated with that. So the flatter the yield curve, here's a 10-year rate and here's a overnight rate. If it's like this, you can make all this money in between. You're taking risk in terms of timing, but you don't have to take a lot of credit risk. But if it's flat, you can't make any money. So he's dumping the banking shares because they can't make money. Why would you buy Barrick? Well, he obviously likes gold. That goes without saying. But Berkshire Hathaway, which is Buffett's investment vehicle, is so big. We're talking, upwards of $1 trillion. You can't buy junior miners. Junior miners can be very, very attractive investments, but they don't move the needle at Berkshire Hathaway. You got to be spending $500 million just to kind of get on the list. Well, there are only a couple of mining companies in the world that are that big. Newmont, Barrick, IAMGOLD, there are a few, but that's it. So Buffett's not going to be buying junior miners anywhere. He doesn't have the time and the ability to attract them. He needs a big name, and Barrick is one of the best. Interestingly, the way Barrick's going to make their money, they'll make money in gold for sure, and their stock price will go up, and it's a smart move by Buffett. But they're not going to make it by exploring. They're going to make it by buying junior miners. That's why for an investor a little bit smaller than Berkshire Hathaway, the junior miners can be attractive.
A rigorous quantitative breakdown of global money supplies confirms the inevitability of a massive precious metals repricing during a systemic collapse. Dividing the global M1 money supply by official central bank gold reserves yields an implied equilibrium valuation of approximately $14,000 per ounce. This skyrocketing dollar price is not a reason to celebrate. It represents the severe devaluation and potential collapse of the world's primary reserve currency. Consequently, major financial conglomerates are aggressively shedding traditional banking shares because near-zero interest rate policies and incredibly flat yield curves have completely broken the classic lending model. For individual investors, holding a physical silver allocation, specifically American Silver Eagles, offers an invaluable security blanket during periods of extreme social and economic disorder. Simultaneously, placing strategic capital into high-grade junior mining companies provides explosive upside potential, as larger mining conglomerates will be forced to acquire these smaller producers to replenish their depleting reserves. Diversifying into tangible wealth today is the ultimate defense against the impending reset of the fiat monetary regime. Share your thoughts about this interview in the comment section below. If you found this video helpful, please hit the like button, subscribe to the channel, and ring the bell icon. Thanks for watching.